Hi, this is Mr. Gideon. When we talk about monetary policy and the importance of money, obviously time makes a difference in how we value money. And part of what happens over time, as you know, is inflation, possibly deflation, or even disinflation. But I want to talk a little bit more about inflation than we have in the past, because particularly when we get to the money market and the loanable funds market, time plays an important role, and the real interest rate is of particular importance there. But there are winners and losers when it comes to inflation. Economists believe that high rates of inflation impose significant economic costs on most people in society. There will be increased transaction costs, also known as shoe leather costs, as there was in the example of the German hyperinflation in the 20s. Increased menu costs for people that own businesses. They have to republish, reprint menus, signs, UPC codes, and greater unit of account costs. But in addition, inflation produces winners and losers. Remember, there's nominal income versus real income. There's nominal GDP versus real GDP, and also nominal interest rates versus real interest rates. And this is really the key piece when we're talking about nominal versus real interest rates. Now, there's a very simple formula for calculating the real interest rate. It's the nominal interest rate, just the number, minus inflation. So let's say there's a loan, and the loan is going to charge the borrower 6%. Well, what's the real interest rate if it's a long-term loan? Let's say it's a one-year loan where the nominal interest rate is 6%, but inflation is 3%. Well, you do 6% minus 3%, and the real interest rate is 3%. One more example. Let's say that the nominal interest rate is 10%. It's pretty high. Inflation is 4%. What's the real interest rate? You guessed it, 6%. Now you could actually calculate the real interest rate beforehand, the expected real interest rate, which is equal to nominal interest rate that's going to be charged minus expected inflation. If you were going to calculate the actual real interest rate, then that would be equal to the nominal interest rate minus the actual inflation. Since loans are usually made for more than a year and they're made in nominal dollar terms, the purchasing power of those dollars when they're finally repaid depends on inflation, which means that particularly if you have a borrower and a lender who expect roughly the same amount of inflation and then something unexpected happens, then you're going to have a winner and a loser. If the actual inflation rate is higher than what was expected, the borrower wins. If the actual inflation rate is lower than what was expected, the lender wins. And you can guess, just based on this formula that we went over, how the numbers could play out in any one scenario. Here's a couple of examples from my own life. In 1979, when I was 9 years old, my parents bought our home. That's the home that I spent most of my childhood in. Real payments, as in real income, real GDP, real interest rates, the real payments that they had to pay in terms of the purchasing power were reduced by higher than expected inflation. That's something that was being experienced throughout the entire economy in the United States. So in our case, as borrowers, my family won. In the mid-1990s, when inflation was falling to lower than expected levels across the United States, and my dad bought his home, this ultimately meant that my dad, as a borrower for that home, was a loser. But unexpected deflation creates winners and losers too. Between 1929 and 1933 in the United States, the Great Depression saw a decrease in the price level of 35%. So, borrowers, farmers and homeowners in particular, saw a dramatic increase in their real payments in terms of real dollars. Many of them went bankrupt, which created a banking crisis. One final note. Disinflation, which is bringing the inflation rate down, is not deflation. If you're going to be engaging in trying to, as a person who's a policymaker, engaging in disinflation or bringing inflation rate to a modest level, keeping it at a modest level like 2 to 3%, it's very difficult and costly if you wait too long. If you wait until a higher rate has already become well established, it's difficult to bring it down to a modest rate, and that's why a lot of times policymakers usually move very swiftly to avoid higher rates early on.